Today we'll be looking at JEPI versus GPIX and what sets them apart. The graphs, the numbers, the percentages. They aren't just symbols, they are the compass that guides an investor towards their desired financial destination. Today we set sail on a journey to unravel the returns, risks, and value of two intriguing financial vessels, JEPI and GPIX. Both offer their unique advantages and challenges, and understanding them can truly set the stage for informed investment decision-making. We will delve into their data, dissect their performance, and decode what they offer to an investor. As we dive into the deep waters of JEPI and GPIX, remember this: knowledge is the best investment you can make. First off, let's unpack JEPI, a seemingly humble player with a sneaky punch. Imagine starting with $10,000. By the end of a certain period, JEPI would have grown that to $10,611. That's a return of 6.11%. Not bad, right? Now let's talk about risk. Picture a roller coaster. The ups and downs represent the standard deviation, which is a measure of the investment's volatility. For JEPI, the roller coaster isn't too wild, with a standard deviation of 6.85%. But what about the biggest drop, you ask? In our roller coaster analogy, that's the maximum drawdown. For JEPI, the scariest drop was only 2.75%. Not too shabby. Now onto the Sharpe ratio. This is like a report card for your investment. It's a measure of how much return you're getting for the risk you're taking. For JEPI, the Sharpe ratio is 1. That's like getting a B on your report card. Pretty decent. The Sortino ratio is similar, but it only cares about the downside or bad volatility. JEPI's Sortino ratio is 1.51, which means it handles the bad times pretty well. Lastly, JEPI is a good team player, showing a benchmark correlation of 0.91. This means it generally moves in the same direction as the overall market. With a return of 6.11% and a respectable Sharpe ratio of 1, JEPI certainly brings some heat to the table. Make sure to subscribe if you find value in this research. Now switch gears and zoom in on GPIX, a seemingly more aggressive contender. Let's dive right into the data. Starting with a balance of $10,000, GPIX managed to boost its end balance to a whopping $11,199. That's a return of 11.99%, nearly double that of JEPI. But with greater rewards come greater risks. This is reflected in GPIX's standard deviation of 10.25%. indicating a higher volatility compared to JEPI. Next up, maximum drawdown, a measure of the largest single drop from peak to bottom. For GPIX, it's at negative 3.65%. A bit higher than JEPI, yes, but remember, no risk, no reward. Let's move on to the Sharpe ratio, a measure of risk-adjusted return. GPIX boasts a Sharpe ratio of 1.76, outpacing GP and demonstrating better risk management. GPIX also outshines JEPI with a Sortino ratio of 3.11, indicating superior return potential for the given level of downside risk. The cherry on top? GPIX's dividend yield is 8.46%, offering an enticing income stream for investors. And let's not forget the expense ratio at a lower 0.29%. GPIX ensures more of your money stays in your pocket. With an impressive return of 11.99% and a Sharpe ratio of 1.76, GPIX sure knows how to play the game. Now, the moment you've been waiting for, JEPI versus GPIX. Who will take the investment crown? Let's start with JEPI. With a starting balance of $10,000, JEPI saw a return of 6.11%, ending with a balance of $10,611. Not too shabby, right? Its standard deviation stood at 6.85% with a maximum drawdown of negative 2.75%. The Sharpe ratio was a solid one, and the Sortino ratio came in at 1.51. The benchmark correlation was at a high of 0.91. These figures, combined with an expense ratio of 0.35% and an impressive dividend yield of 7.34%, paint an attractive picture of JEPI as a reliable player in the investment game. But what about GPIX? Starting from the same $10,000, GPIX boasted a return of 11.99%, rounding off with a balance of $11,199. Its standard deviation was somewhat higher at 10.25%, and the maximum drawdown was negative 3.65%. However, GPIX, shown in its Sharpe ratio of 1.76 and Sortino ratio of 3.11. The benchmark correlation was near perfect at 0.99, with an even lower expense ratio of 0.29% and a higher dividend yield of 8.46%. GPX isn't just a contender, it's a heavyweight. Comparing these two, it's clear that both JEPI and GPIX have their strengths and weaknesses. JEPI offers stability with its lower standard deviation and maximum drawdown, while GPIX promises higher potential returns. The expense ratios and dividend yields also differ, with GPX offering slightly better terms. The benchmark correlation of both is high, indicating that they closely follow market trends. Whether you're Team JEPI or Team GPIX, remember, in the thrilling game of investments, the best player is always an informed one.